Hello, ladies and gentlemen. Welcome to the show today. Today is Thursday, the 29th of October, 2020. Now, you know what? This is a game of chicken that's going on between the Federal Reserve and all the markets. They're withholding stimulus and stuff, and they're not really doing a whole lot more right now at this moment to support the markets. And the markets are starting to fall off, and they're waiting to see just what's going to happen. They'll only react if they need to react. But it's like a game of chicken between the bears, which are the people who, well, the bears in the stock market, they want the market to go down, the bears, and they might even short the market or whatever, but they want the market to go down because they're going to make money off the bears on the market. And the bears and the Fed are in a game of chicken. Now, the bears, they got a car they're driving down the highway in this game of chicken. They're like a bunch of clowns driving this clown car, and they're heading toward the Fed. Which one's going to swerve off the highway first, and the Fed's going 60 miles an hour toward them, and they're going 60 miles an hour toward the Fed. And this is what they're driving, and this is what the Fed's driving. Who do you think's going to win this game of chicken? The bears or the Fed, Because this market's only going to fall so far before the Fed reacts. And how the Fed's going to react is they're going to do whatever it takes. Whatever it takes. And they got a printing press. And so they can bring this market back up. But they're not going to do it unless they need to. And the need only comes if the market starts to fall. As long as the market's going along fairly, fair, I'll tell you where the point is, where the Fed's really going to react big if the market does fall. 20,000. As soon as that market goes down to 19,999, boom, here comes the money. Okay, so they're not going to let, you see these guys out there right now saying 80% fall in the market? Don't count on it. Don't count on it happening. They're going to print. They're going to print and print and print. So, for you guys out there that are market bulls, if you can buy the dip and get down to the right point, the thing is knowing when the Fed is going to react to this market. Now, I'm giving you guys what I think. When I think they're going to react to this market, I think they're going to react at some point above 20,000, but they might let it go as low as 20,000 before they react. But if you can buy on that dip, you'll do good, just like the guys who bought back earlier this year when it went down to like 19,800 or something like that. And they bought in right then. Look how good they did. This is wash, rinse, repeat. That's all it is. Well, let's get started. Let's take a look at what's going on. Let's open up the charts right here and take a look at the silver price today. We're looking at $23.31 on silver. It's down 3 cents today. But, it's found a new range. The new range is about $23.30. Right where it is right now. That's the new range, It's come down from the old range, which was $24.50. Let's take a look at gold. Gold's at $18.68, and it's down $8.10 on the day. So gold's not looking so good. This is deflation that's happening right now, and the Fed's not going to let this go too far. Because if it goes too far, if they let it, actually the Fed's playing this game of chicken, but it's an awful dangerous game. Because if they let this go too far and the deflation gets too entrenched, it's going to take an awful lot more money to pick it up back out. And the problem with that is confidence will be lost in the dollar if they do that. But they'll have to do that because in a deflationary vortex, it's like the opposite of a tornado. It's like going into a black hole. It would just suck up everything, ultimately, the deflation, because the system is so over-leveraged. There'd be no money left. As the margin calls and everything goes out, the derivatives would melt down. Everything would melt down. It would just be a cascading effect, almost like dominoes falling. Each domino makes a bigger domino fall. And ultimately, in the end, all the banks would fail. Everything would just melt down and stop. this means that they would lose power. You really think they're going to let that happen? They're going to do anything it takes to maintain power and control, because they would not fare well in the kind of world that would happen if they let everything completely collapse. Then these people that are in charge would not fare well in that kind of a world. Well, we wouldn't fare well either. But they're in control. They're not going to let that happen, because it's basically they would not fare well in that. They know it. They've got their top economists and stuff. They know what would happen if they were to quit supporting the system completely. How it would deleverage. The entire system would deleverage right down to where there's no money left. And everybody would go bankrupt. Everything would stop. They can't let that happen, guys. So an 80% drop in the markets would do that. 80, 90% drop in the markets, and it would roll over that far. Let's take a look at cryptocurrency now. $397.4 billion. With a Bitcoin dominance, it doesn't say the Bitcoin dominance there. Oh, there it is. 62.7%. Boy, it's getting up really high, the Bitcoin dominance. 13,489 for Bitcoin today. Let's take a look now at the Dow Jones Industrial Average, and she's up 105 points. You know, I'm very suspicious right now about this. I am suspicious that the Fed isn't done something to turn it a little bit. It wouldn't take much, you know, this little drop that they were having. It seems to have stemmed off and stopped. I'm suspicious that they might not have used the plunge protection team or whatever or something, you know. I don't trust them now at this point. And when it comes to controlling these markets, they've got so much control over these markets. It's unbelievable, the control that they have. Let's take a look now at, but you know, ultimately, if the market started to roll over, they would have to come in with major, stimulus, monetary policy, major monetary policy, and probably fiscal stimulus as well, you know, to actually turn if these markets drop too far. Like if they do let it drop below 20,000, and then they come in other words, what I'm trying to say is it's going to take a heck of a lot more money if they let it drop below 20,000, you know, to bring it back up. And that's what it took last time. Last time it dropped right here on March 15th. It hit its low of this year of 19,173, okay? And look at what $3.2 trillion did. It brought it all the way up to its peak of around 28,586. So it made the market rise over 9,000 points. The market went up over 9,000 points on $3.2 trillion worth of stimulus. If it drops below 20,000 this time, it's probably going to take $4 trillion worth of stimulus to bring it back up. But they'll do it. They'll do it. I have no doubts in my mind that they'll do it. Let's take a look now at crude oil. Crude oil is $35.93, and it's deflating. Everything right now is deflating a little bit. We're in a little bit of a deflation right now. That's because they haven't done any real major, they haven't done any real major work on this stuff in quite a little while, since way back when they did the last stimulus. They're kind of riding on that big stimulus they did back in March, and they're kind of seeing how far that'll get them. Basically, what's happened is they're being a little bit on the stingy side right now, you know, and they're seeing how far they can get in. They're trying to drag this thing out as far as they can. They're letting a little bit of deflation in the system to offset the amount of stimulus that they're doing, to try to keep things on a level playing field. You know, that's what they're trying to do, you know. Anyway, bonds and rates today. We're looking at, on the treasuries, we're looking at treasury yields rising. They're going to have to do something here, too. They can't let these yields rise too high. They can't let the U.S. 30-year go more than 2%. Well, they can. They can let it go more than 2%, but they're not going to let it go more than 2%. And the U.S. 10-year, they're not going to let it rise over 1%. You know, They're gonna come in. They're gonna come in. You watch. They'll come in, and I think they're already doing yield curve control. To tell you guys the truth, I think they're doing yield curve control. But I don't think that they're publicizing it or whatever. I think that somehow they're doing it sneaky, in a sneaky way that we don't even know that they're doing it. The MOVE index today, 57.13. Now this is a really important index right here, because if this index goes up too high, the credit markets start to freeze, you know. And right now it's at 57.13 on the MOVE index, which is high. But it has to pretty much go over 100 before the credit markets get endangered. And so they keep their eye on this like a hawk. This is probably what they watch this MOVE index. So that's why we watch it. Okay, the US dollar index today. We got a pop in the dollar. It's popping up. It's over 94 again. It's up 0.64% on the day so far. So the dollar's going along, ticking along pretty strong, you know. Let's take a look at our funny picture for the day and see what it is. Now, this picture right here is self-explanatory. But that's an awful cute little mask that they made for the cat, you know. It's so tiny, such a tiny little mask. And it fits so good. It fits her face so good, you know. You know, cats can catch that virus. There's been a number of cases of dogs and cats catching it. Anyway, a tiny little mask. I thought that was awful cute, you know. She's a cute cat. Pretty eyes, doesn't she? Big green eyes. Thank you guys for listening to my show. Like and subscribe. Give me a thumbs up, and we'll catch you guys in the very next episode. Bye-bye.